The world has completely changed because of AI and what's happening right now all around us.
The IPO market has been pretty sticky for like the last 3 years, but it's still not as active as it's been.
Building a startup is like burning through fire. So why they are putting themselves again through so much pain? So it has to come with a deeper purpose because it's not money. Founders in India are at least working like 7 days a week, 12 hours each day, not just founders, their teams. And deals are getting closed, in a matter of days. Invest in the greatest of people. Trends might change, but the best of people, they'll figure it out.
So we're super excited to launch DSM Connects with Sid. And really with the podcast, we just want to talk with great minds, with founders, emerging managers across the globe. And in the end of the day, like this is a space that it's all about knowing the right people, knowing the right talents, getting the intel. So hopefully we'll have a super interesting conversation that we can just talk about founders, what's happening in the family office space, investing across the globe.
Thanks,
So
Mona.
yeah.
Excited to join you.
Thanks so much for doing that. Do you want to tell a bit more about Neon Fund?
Sure.
What you guys are up to? What
Absolutely.
you're looking at?
Yeah. So my colleague Udit and I are today in Zurich recording this podcast with you in Switzerland. And to give you a brief about Neon Fund, we are considered the #2 AI fund from India. And at Neon, our goal is to build the India-US corridor 10x bigger than the US-Israel corridor. And there are a few reasons, right? The US-Israel corridor started happening 20 years ago, and it produced companies like Wiz, which is a $32 billion acquisition by Google, and many other fantastic companies. And we are seeing the early indications that's happening from India to the US. Companies like Freshworks, which listed on NASDAQ for $15 billion. So at Neon Fund, we back the best of second-time founders. For example, the co-founders of Freshworks, which took company public, they started Atomic Work. We are the first check in them. We are the pre-seed check, and we have backed 60 such founders at the earlier stages who are building the enterprise AI in the US-India corridor. And previously, before building Neon, I built a company in B2B healthcare space. We built CRM for pediatrician, sold that company to a larger company. What we are known for is today is Neon Fund, and more importantly, Neon Show, the second largest podcast globally by any VC fund. We get like millions of views every month.
Yeah.
Have 250,000 plus subscribers or just on our YouTube channel.
That is amazing. Like, honestly, having the access of those second time founders as well, that you've seen that they did what they said they will do. I mean, that's incredible. But how did you build that network? And also, like, in terms of the podcast, like, I'm impressed by the amount of viewers you have in the space. So how you're able to like pull that all together?
So few things, it's all started. I had sold my venture, the first venture in 2017. We started the podcast, Nancy and I. Nancy is my co-founder in 2018. The goal was just to learn outside healthcare and to hang out with the best minds possible. And the thesis was that, hey, this will show us what will we do next. So we were completely open minded at that point in time. And what happened is, because of this, what we realized, we were ourselves second time founders, and other second time founders who were hearing our podcast started reaching out to us that we would like to partner with you with any form. So we hadn't started the fund yet. So the fund was born out of a pull by second time founders because they saw our podcast and they said, we want to partner with you.
Yeah.
And we thought like this could be one way of the partnership where we could be vested in them.
So basically, your LPs a lot of the times are also second time
Yes,
founders.
yes. Our LPs are also second time founders.
And can you invest in first time founders or exclusively second time
No,
founders?
so what we do is 50% of our fund we always keep for second time founders,
Yeah.
and average 50% usually comes out to be
Yeah.
first time founders, because our goal is to build an ecosystem. So ecosystem cannot be built by only by second time founders.
Yeah.
So what it helps is the 50% first time founders get uplifted by the community, the knowledge, the network of the second time founders we back.
But how do you know that when the second time founder, because sometimes it happens that when a founder builds a business, however years it takes to do that, like they're in a certain space or like phasing their life, right? Like they're like full on proving, like they're sometimes like making sure that everyone knows they can make it. Once they do it, they sell the company, they enter this empty space of like, oh wow, like okay, what's next, right? And maybe they try another sector, or maybe they move a bit towards in the same sector or industry where they already built one. Um, but they might try some things in between. So how do you know that they can do it again? Like how do you know that the next idea is the next big standalone company that they will build?
So usually our criteria for second time founders is in their first exit or the last exit which they had, uh, they should have financially retired,
Yeah,
right?
yeah,
And they don't need money, you know,
to build anything.
to build
Yeah,
anything, right? So that's why when somebody is financially retired and they start any new venture, it means that they have thought through a lot,
yeah,
because not only they are putting their reputation online, building a startup is like burning through fire,
yeah,
right? So why they are putting themselves again through so much pain? So it has to come with a deeper purpose, because
yeah,
it's not money.
yeah.
So which is the first factor, and the second factor is their previous team joining them, which is a good signal.
Oh, that's a good one.
Yeah. Are their previous investors wanting to invest? Because if they had a good exit,
Yeah,
they want to invest, And we do a lot of DD, like the previous company that they sold to, their previous investor, their previous team members. I think the good thing about second time founders is they leave a lot of data behind them.
yeah, that's true. There's so many reference that you can,
Yeah.
like so many reference points that you can touch base on.
Yes.
But what about the founding teams? Like, do you see a lot of the times that the core team is coming together and like they continue building? Or do you like see the exit founders as like maybe it's the CTO that goes to the next round and you will back the CTO? Or does it matter like what was the last function of the founder? Or do you have like any like patterns that you could recognize and say, well, 50% is the founders, like the co-founders that founder CEOs that you will back the next company?
So the most special person for us is, when we are backing is the CEO again building another time.
Yeah,
Because what happens is the pressure of an exit, the pressure of capital raising, and the pressure of building the team, like largely is taken care of by the CEO. The
yeah,
CTO and the other co-founders take care of operations, uh, technology, which is again very important.
yeah,
But navigating an exit is the CEO's responsibility,
100%. That's
right? So
true.
is the CEO, when he or she is starting up, are the rest CTO and the other teams joining them? So this is a big green flag or a red flag if they are not joining them.
Yeah, it makes sense. But what about, because we at DSM Capital, we work a lot with family offices, and a lot of the times those family offices are built by exit founders.
Yes.
And I feel like the tendency that we are seeing a lot of the times, these exit founders, they go on and continue as founders even in investment space. Like kind of you did the
Yes.
same. So you're an exit founder, now you're building your own fund. So we see a lot of founders, they continue investing a lot of the times locally, kind of early on into the companies. Some of those from the networks of the other founders that they know, sometimes new entrepreneurs exactly like you. But how do you see that, like in terms of like focus? Because sometimes I see those family offices that they come out of their exit and they might diversify like kind of a large portfolio of like a lot of different things. So how much you can make it a niche without losing an opportunity, and how much you need to kind of block out, because I'm sure you see a lot of amazing founders, but the sectors that they're operating in might not really fall into your expertise. So how much you need to kind of like make sure that the portfolio stays tight.
So I can share my learnings of working with some of the best family offices in Europe.
Yeah.
They are based out of Geneva and places like that. And what they have done is, let's say their father built a large company and they help their previous generations build that company. So once that company was bought by a PE or somebody else, uh, 50% of their money is managed by their wealth manager.
Yeah,
right?
indeed.
So they will let the wealth manager manage it for their kids, and so that there's continuity and there is least amount of risk. But 50% they want to invest in their own learning.
Yeah.
And by learning means, they'll try to find out again the best founders globally, the best managers globally, who they want to be part of, right? And they're not doing it for money, because the 50% is being taken care already by the wealth manager.
Yeah.
This
It's
they
their
are
sandbox.
putting in so that they can get in the right network, and
Yeah.
thereby they are putting in effort. The other folks are like, I have seen, some other family offices where they give 100% of the money to the wealth manager.
Yeah.
So it's up to, how each family office want to optimize for continuation of wealth versus learning, and
Yeah.
both can go hand in hand.
Yeah, I think that's a good point that you mentioned that, because I think that's also a lot of the same we see. Like it's a lot like based on where the capital was kind of made. Like if the industry is rather, it can be software, but maybe it was more, like traditional software, or maybe it was more like industrial company that the
Yeah.
capital was coming from. So I feel like maybe then they're more inclined to have less risky investments, and maybe they do more funds or fund of funds to kind of make sure that um, it's diversified, and it takes also less time from them, right? Like it's different DD they need to do, because they talk with the wealth manager and they're hired to do the job for them. So, but how do you see that? Like, do you still see some founders that maybe they have their wealth managers that they take most of, like, care of the most of their capital, and then they continue building a company? Like, is there a threshold how much you expect the founder to invest in the new venture in terms of their capital? Or
Yeah, so great question. So again, comes back to dimensions of a family office.
yeah.
I can again talk the best practices that I've seen follow. So once you have given your money to the wealth manager first of all will also optimize for their own incentive. And the second is they'll try to, nobody gets fired for buying IBM. So they'll try to buy as safe assets as possible, or as high brand name as possible, and which might not give the best return because they're not getting, in their minds, paid to get the best returns. Their job is to preserve the capital, right? But the other 50% is because the world has completely changed because of AI and what's happening right now all around us, right? So 50% they want to manage it themselves, and then because they know that the kids are getting born into a different era, and their own learnings might not apply in this AI era which they had previously. So they want at least for their kids, to get invested into the best of managers, founders. Best example AI, the best of AI funds in the world, and each part of the fund, not just concentrating all in the US, but different corridors like US Israel corridor, US India corridor, or it can be US Europe corridor also,
Yeah.
right? So that you can imagine they're building it for their kids. Their kids can have the right opportunities to learn. So tomorrow, if they have a great relationship with a founder they invested in, on an emerging manager like us they invested in, they can ask their kids to intern with us, which has happened in the past.
Really
Yeah.
interesting. But okay, you tackle AI, which I think it's something that it's been on the lips of a lot of people this year. And we see also a lot of like families and investors, they want to get into the space, but it's also a bit like, how should I do it? How much I should do it, and with whom? Because of course, like, tech is getting super polarized. Like, the winners are like, there's very few winners that will actually make it, because in the end of the day, like, a lot of these LLM models and companies are very capital intense, and also you need really strong partners around you, not just capital, but like, partnership. So you can just, like, for example, robotics, like you can just apply into their production lines, or whether it's retail or commerce or like manufacturing, whatever, like you can use your partners to grow and scale and get the data. So it's a complex world, and we're still early on. Even we've seen like some incredible success cases, like for example, Anthropic. I think they've grown incredibly well in the last 12 months. But how do you look at this space as an investor, as a fund, because you're investing early on? So how do you kind of cut through the noise, but at the same time make sure that you take enough risk to bet on the boldest founders and companies?
So again, coming back, let me give some examples.
Yeah.
So companies like Figma, built by, let's say, founders like Dallin, are first-time founders. But if you see OpenAI, Anthropic, both are like second-time founders.
Yeah.
They have built multiple companies in the past, right? And there are so many examples. The founder of Uber, Palantir was second-time founder,
Yeah. Figure
right?
AI.
Right. So I think the thesis is simple. Globally, if you follow the principle, find the best of people, which means in our case or in case of family offices, find the best of second-time founders, right? I think it has to be people-driven,
Yeah.
right? Who are the people? And it's not difficult. It just requires a lot of hard work.
Yeah.
You go and ask, 10 people who are the best founders in the region building in AI, right? And if you keep on doing repeatedly, through your references, through your contacts, through people outside even your network, yeah, you get pointed out to the right folks.
Yeah.
And once you have the right folks, let's say in case of us, once we identify a second-time founder referred to by we just do anything in the world, try to add as much value before even we discuss about investing in them,
Yeah.
to try to be part of their journey. I think the same family offices can follow if they have bandwidth. Like, try to identify the best managers globally, the best founders globally,
Yeah.
and try to add value to them. It requires a lot of work. So in that cases, they can outsource it to people like you and me.
Yeah, totally. I mean, I want to get back to the value add because this is something that it's been in the space, but let's get to that after. One thing I really want to mention is I do think that the relationship between investors or LPs and the fund managers are so both ways. Like, it's not just, the manager to the LP and being like, okay, we'll keep you posted on what's
Yes.
going on and what we're seeing, but it's really like the LP also being active with the managers, because the reality is, at least in our case, when we see later stage in pre-IPO, if you have a good relationship with the manager, like, you will access deals that are not wildly announced, right? Because maybe there is less timeline for those deals, or maybe it's less information, or it's a bit more sensitive. So then if the LP is close to the manager or it's close to the source, like, it's so much easier to share those deals because you have the trust, you know how each works, right? So it's a relationship that goes both ways to get the best value, I think. But how do you see that? Because of course, like, you have massive network of LPs that they have their IP in terms of access and network. So how do you deal with that? Like, how do you make sure that you keep everyone posted?
So one way that we do is, once we invest, for our LPs, let's say family offices based out of Europe and US and India, we offer them co-investment rights.
Yeah.
And what we do is we ask them, don't invest through an SPV. We don't create SPVs, right? In our case,
Yeah.
once they have invested in the fund, we'll try to bring them on the cap table along with the founder.
Yeah. It's
And
direct
once
access.
they have direct access to the
Yeah.
founder, their learning goes multifold. So they're not just dependent on us for the reporting. And we try to do that actively
Yeah.
for our LPs, get them directly on the cap table.
Well, I think it's super interesting how the market is really changing, right? Because before it used to be like, if LPs or investors wanted to invest in VC, like, it would always go to a fund. But now it's like merging managers are opening the doors or windows
Yeah.
to whether a lot of managers they do through SPVs, or like you do
Yeah.
directly to the cap table. It's just like almost like democratizing the access to early stage of VC and growth, no?
Yeah, absolutely. And I think that's necessary. One reason is that the world is changing so fast that you cannot depend on any manager that you invest in, because results will only come in 6 to 10 years on what has worked and what has not worked.
Yeah.
So in that case, you can be as close to truth as possible, which is the founder.
Yeah.
Right.
Yeah.
And most of our founders follow the practice, at least that we do invest in, follow our practice of sending monthly updates. So we send monthly updates to our LPs, and our founders send monthly updates to all their investors, which means if we have bought on their LPs, unfortunately, they're getting 2 updates the same month, one from the founder and one from us. But I think over communication is good,
Yeah.
under communication is not good.
Exactly. Better to like over communicate, right?
Yeah.
Yeah. But what about the value add? Because as a context, I think especially in the last years, it was when the market was like more in the hands of founders. So founders had more negotiating power. So a lot of VCs went back and took their term sheets and said how much they're going to create value with the founders and help the companies. But in the end of the day, they are still investors, and sometimes they couldn't really deliver the word. So how do you actually create value there?
So value add is pretty simple. Whenever founders are starting again, even if doesn't matter, their nth time, and I've created billion-dollar companies in the past, they are always starting from scratch,
Yeah.
and they have the same kind of nervousness. They have the same kind of unsurety that this might not work, right?
Yeah.
But at that stage, if you can help them with the right potential customer intros, team intros, right, of what the team that they want to build in, right, and if you can just help them provide a brainstorming partner. And similarly at that stage, if your LPs are also being, founders or operators in the past, you can start connecting them with the founders that you want to invest in without any investment done. So your LPs also appreciate that,
Yeah.
hey, their circle and their learning is getting broader at the same time. So it's like a flywheel, the people that you want to invest in, you connect it, with them, their customers. In case in our case, we have many CIOs globally as our LPs.
Yeah.
So these founders know that they're getting access to Fortune 500 CIO network with us.
Really?
Yeah,
And when you say you have LPs as CIOs, do you mean that they invest personally or?
they invest personally.
Yeah.
Or if the CIO has previously had large wealth, they would have obviously created a family office.
Yeah. Yeah, exactly. Then
Yeah.
they carry on that.
I can ask you a few things.
Yeah.
Since you are working with so many family offices today, and the the world is changing so fast. So
Yeah.
what is the demand from the family offices that they have today from you?
Yeah. I think amazing question. And I think it's this year and last year it was very clear. So because there was a lot of families that they invested in VC, and maybe they, a couple years back they did a couple funds and couple directs, and it's been taking more time to get liquidity as anyone really could expect. So right now a lot of families, they want to invest in or they be looking for assets where they have visibility to the winner. So they kind of already know what are the top three players in that field. And then the second thing is to see more like a window to liquidity, so that in the next 2 to 5 years they can have good visibility to an exit. So that's something that we've seen a lot. I think last year we saw, now that you mentioned AI, we saw a lot of families that they wanted to understand the LLM space and see what are the players that are in that layer. And this year we had a lot of demand for robotics, because that's really a layer or like a sector that is being unlocked with these LLMs, right? Like now it's so much faster to train a robotic in different environments, in like with different species, with different tasks, just because there's AI and you can teach them way faster. And the crazy part is that they're learning on their own and from you and from the environment. So they're improving constantly. So that bottleneck that it's been there for almost decades, right? It's something that it really opened now that LLMs started to work at scale. I would say also there's a lot more, and I don't know if you've seen the same, I would be curious to hear, but there's been a lot more awareness in the hardware space. So I felt like a lot of VCs before, like a couple years back, like they wouldn't ever even look at hardware, right? Like they would be just like pure software and that's it, right? But now it's been like AI chips, LPUs, and what's going on with the data centers, like what's happening in the liquid cooling system. So it's been getting way more, hardware heavy. So VCs or like even families, they want to be involved in the infrastructure layer, and there's been good cases like CoreWeave that they got listed, and there was good success after the IPO. So I would say like those three layers are something that is being a lot in the minds of families that we were speaking with. And like I said, like liquidity and like visibility to liquidity and visibility to the market winners. But what I wanted to ask from you, I'll like turn around the question is how do you see in the early space? Because also India is a market that's going super fast and moving extremely quick. So have you seen similar tendencies there like in early stage companies, or what do you see there?
So I think the unique thing about India today is, uh, uh, in the last 3 to 4 years, every year, uh, on an average, 300 to 400 companies would have gone IPO. Half of them on the uh, like SME exchange, which is the exchange for, like the small businesses,
Yeah.
and half of the main exchange. So the rule of the SME exchange is any company which is less than $8 million in revenue will go IPO on the SME exchange, and any company which is greater than $8 million in annual revenue will go on the main exchange. And this is a common pattern that we are seeing today is companies are going public in India really fast. Like in US, the timeline to go public has gone from, let's say Amazon went public in 5 years
Yeah.
after founding, launched in 1994, I believe, and gone public in 1999. Today, if you see companies are private for 15, 16 years.
Exactly. It went from like, I think the average was 7 years and now it's like 17.
Yes.
Best case scenario.
And that's the best case scenario. And
Yeah.
for the best case to happen, now the benchmark in the US is $1 billion in revenue, like Figma, CoreWeave, and so many other. The good thing about Indian ecosystem is you can go IPO as low as 10 million annual revenues.
Wow, that's insane.
You have to be profitable because the regulators in India called SEBI, they monitor you very closely, each company, because they want to ensure that no fraud can happen in the market, which can have ripple effects on the
Yeah.
other players.
But that's almost like a Series A company.
Yeah,
It
that's
makes
almost
sense.
like a Series A company.
That's wild.
Yeah, and a company at 10 million revenues has happened in like 50 of them in the last, let's say, 24 months. 10 million revenue would have gone IPO, and they would be valued anywhere between 50 million if they are a hardware company or a services company, to 150 million if they are a pure software company.
Wow.
So these kind of exit options are available in India. And what we are seeing, another unique trend, Indian software companies that were US HQ companies, that's the space we invest in. We are a US HQ fund. So these companies, because they went from 50 to 100 million in revenues, and they have been existing for 8 to 10 years. They are companies like Capillary, Moengage, Clever Tap. They now are flipping back to India. They are paying a tax in the US so that they can go IPO in India at $1 billion valuation. So India is right now the craziest market to go IPO in.
And what's the longevity of this trend? Like how long are the legs? Like, do you think that they will sustain a good market cap? And is there like a lockup period for both exchanges? And is it 6 months, or how does it work? Like, yeah.
So the lock-in period is obviously 6 months
Yeah.
for employees as well as investors, or either you can sell it for also on the before the IPO and offer for sale. There is the OFS that happens just before the day of the IPO or a few days before the IPO. So you can, as an investor or an employee, sell during that time also. But the good thing is that Indian markets, the regulators had kept it very strict for the longest period of time, and they realized this. So the last 3 4 years they opened it, and that's why so many IPOs are happening. So we this trend for to go for another 5 to 10 years, till maybe a US like situation will happen. There are too many companies which have gone IPO,
Yeah.
and like investors are finding it difficult, which company they should put money in.
Exactly, that's the thing. Because in the end of the day, it's like you bring a lot of visibility to the market, but then at the same time, because the market is so large and there's so much going on, like you need a proper tools to kind of like go through that market and understand who are the winners and where you should kind of place your bets.
Yes. So I think investors have a 5 to 10 year window, as I said, to reap benefits of the Indian IPO
Yeah.
markets. And earlier people would believe that it's difficult to take money out of India. Now the government has resolved all these issues, so that's not a problem anymore for global investors, especially European investors who want to be part of the India story.
Yeah, that is so wild because it's like almost other way around. It's opposite in the US, right? Because now there the IPO market has been pretty sticky for like the
Yes.
last 3 years. And it still seems to be, even we see some cases that are like generating some confidence, but it's still not as active as it's been. So hence, and the market, the private market has a lot more capital now to offer,
Yes.
like because from all these, structures that investors can invest directly into Databricks or Croc or Anthropic, even the private, right, through SPVs or managers or even directly in the cap tables. So there is now so much capital available in the private markets that a lot of companies don't need to go public yet. And they kind of prefer to do that to keep it keep things more straightforward so they don't need to report a lot of things. So I think it's so interesting that you guys go like almost other way around. Like now you like kind of go even earlier, and in the US it's other way around. Like companies like we said taking 70 years to list.
Yes.
Right?
I want to ask you one thing.
Yeah.
So, you work with a lot of European family offices, the best of them. So, what is their asset allocation strategy today? Like how much they want to invest in Europe, how much they want to invest in the US, and then the rest of the world, and how much public versus private?
Yeah, I mean that's a great question. I think it depends. I hate to say this, but it depends a lot on the maturity of the family office, like how long they've been around, like where their portfolio is as of now. Like are they building the portfolio still now, or is it more on the management side that they're just adding a couple more positions, but continuing with their current strategy, or are they doing shifts in their structure and the strategy? So I think it depends massively. It depends a lot on how much time they have available, how big is their team, and how much risk they're willing to take. So it's pretty complex, I would say, because some family offices that they've been doing VC for a long time, like they've got a portfolio of, they started with fund of funds, then they went to primary funds, they started to do co-invest, and then they started to do primaries, and now they do also secondaries and maybe even GP-lets, right? So those are like the most institutional families that they've been able to build that private market portfolio that it's very complete. And with that, they match the liquidity profiles, right? Like fund of fund, less risky, less liquid. Funds from there a bit, it's not as, it's more riskier, but and more liquid compared to fund of funds because it's just one instead of 20 or 30. And when it comes to secondaries, they're avoiding the J curve. So they try to get distributions already, in the year 2 or 3. And also one super important thing, what they're doing there is when they buy secondaries at discount, let's say they buy at 40% discount, in their books, they mark it at 1. So instead of marking at 60, they mark it at 1. Or like 100, sorry. So that means that in day one, they get 40% uplift because they bought at 40% discount. So that's like the most sophisticated and ready portfolio that some family offices in Europe have, which is, I think, is amazing. But then there's also families that they started with couple funds, so they get visibility to the market and access. And then from there, they start to build their own portfolio of positions. And it can be later stage. So they match the more liquid profile because if these companies are successful, they're the ones that are IPOing first. And then they might do couple growth positions and then earlier cases where they might be a bit more active. So in those cases, again, you try to match the timeline in liquidity and risk. So that's something that I would say it's a medium case. And then I think, unfortunately, there are still cases or families that they are still, not unfortunately, but they are still figuring out like the strategy, right? So they're like trying to find, maybe they're a bit, lost in the strategy, which is understandable, right? Like maybe they build a massive company in e-commerce or fintech or whatnot, right? And now they try to figure out how to build their portfolio. So sometimes it happens that they try things and then they are stuck in that position and they try to move things around. So I would say there are a lot of different ways of doing things. And it depends on the mindset. Like you can't like if there's an, family office that they have the mindset of investing in very like, let's say, futuristic companies or companies that they have a lot of risk of that market evolving and becoming like, for example, robotics, like it's still super early in robotics, so, or space. So I think it depends a lot as well, like how much they're willing to take risks, like how much they do directs compared to fund of funds and funds. But I'm not answering the question of like, I'm just talking about the private markets. I can't really talk about the public market because we don't really get into that. But I would say that that portfolio, that block, which a lot of the times is maybe 5 to 30% of their wealth, is somewhere there.
And how much, if you can say, for let's say, you can take example of any family office, right? How much they would want to put in Europe versus outside Europe?
Tough one, especially now this year, right? Like, because some families, they're a bit like on a wait and see with the US. And they're like, okay, let's see how everything folds. And then some families, they've been doing a lot of US and they continue doing that. So again, depends a lot. Like I would say in some cases it goes from like 90% US and 10% Europe, all the way to 30% US and 70% or even 100% Europe. So there are families that they double down now on Europe and some that they just double down on
But
the
but
US.
I believe they do realize that, right? Their own European companies like Lovable
Yeah,
or Spotify,
I know.
they're all USHQ companies.
But Spotify now is kind of a US company,
Yes.
right? And
Oh,
I grew up actually like my relative, he like in way back like 50 years ago as a Christmas gift, he gave us the premium cards of
yeah.
Spotify as a Christmas gift for 3 months. And since then I've been premium at Spotify. But now, I mean, and for me it was Swedish company. But now it's a US company. Same with Klarna, right?
Yeah. So they realize that even the best of European companies are USHQ companies. So what's the reason for them to to keep their money back in Europe?
Like what do you mean?
Like, if they said, to tell you that to show us only assets which are HQ'd in Europe. So are there folks like that?
Yeah. And I honestly, I have to say, even I'm European, that this is not a popular
Yeah.
answer to say, but I mean, you have to be looking at US. That's where the capital markets are. Like that's, if you look at the best companies, they're there, whether they're European or US. So, so in Europe, we have to work like 100 times better and faster and more efficient to make up that gap, but we're still not there. So why they do it, it's their preference.
Yeah. And are these family offices preparing for the next 20, 30 years for the children? Because you talk to them day in, day out.
Yeah. So I think I haven't asked that, maybe I should have. But I think a lot of the times with these companies, if it's VC fund, it's a long-term game. So in the end of the day, I do believe that they always have that at their back of the mind to kind of like continue building. And like you said before, like for them, for their kids, it's an amazing way to get access and transparency and visibility to this market, like almost for free, right? So yeah, I think that's for sure something that people, are thinking about.
And can you tell, like, uh, are SPVs really popular, and do you see them becoming more popular in the next few years?
Oh yes,
What's the
yes.
reason for that?
So I think there are several reasons for that. So one, for example, which is I would say pretty latest trend. So for example, if you are super as a manager, maybe you're an emerging manager, you're super close to a top CEO and they are raising now 2 billion, right? You have a lot of pro rata because the CEO is close to you, you invested early on, like you can be involved and they're happy to bring you in. But the thing is that your fund size is a certain size, right? And you can't write more checks, but you could get 500 million allocation or 1 billion allocation to the company because you have such a strong relationship. So what are you going to do? you're going to open the SPV to your LPs and friends and investors so they can access the same that you can access because of your relationship. So that's one reason. One reason is there's a lot of secondaries that early investors, founders, and employees that they need to circulate, right? Like they need to sell for different reasons. If it's an employee or founder, for practical reasons can be, or early investor, they're at the end of their fund life cycle and they just need to exit the position. So for those, SPVs are really good vehicles to kind of pool the capital, and then the investors, they don't need to take entire blocks. Like imagine you're a family office, you want to invest, you want to do 5 companies, and you want to put 1 million in each company. And if you buy from, large blocks, like you can't do that diversification. So if you access those SPVs, it's way easier to, set your ticket based on your appetites. So I do think that SPVs are something that it's such a good tool and it's useful tool for these LPs, and of course managers are keeping their eyes and ears open to like what their LPs are asking for, because raising funds are more difficult than it's ever been, right? It's really tough. So they're like, okay, what are the ways to keep our LPs involved? They're asking for directs. Let's give them directs. So I think SPVs definitely are something that is they've been increasingly popular, and also a good tool to help investors to access with flexible tickets into those companies. Imagine investing in Figma like 100K. You don't need to do 5 million.
Yeah.
So it's like you own the company and you're like, great.
Yeah. And you bought in at like 10 billion or so. So today you are already sitting at 6x in Sigma if you were participant at that time.
Exactly. So that's the thing. Like that's the way to kind of open up and make the private market more accessible, not just for institutional investors, which used to be the case, but also for families that they want to be involved in these returns.
And how do you get access to the best companies for DSM?
Yeah, so for us, I would say we're very, very lucky to have great people around us and strong relationship with institutional GPs, that they have very good relationships over the last years with these founders and management teams. So that's something that really helps us, and they also help set up like they're setting up the SPV and they have the information. So I think that's a great tool to have good partners. Like I'm a huge believer of good partners. And also if there are cases that are directly on the cap tables or directly with the management teams, like it's because of the presence that we had in the last years in the market, both on the sides of investors, but also on the sides with the founders and companies. So it's a really long-term game, I think.
That's quite amazing.
Yeah, I mean, you have the same, right? Like you've been building your IP for long, and you never know who's sitting next to you, right?
Yeah.
And you never know where that intro is, if someone is introducing you to somebody, like where it's leading. It's like such a like,
Yes.
Yeah,
you're not you keep on giving the right inputs, and you don't know when your next Figma is going to come. Right.
Exactly. And I do think that in this industry that is so competitive, you need to build good partnerships and be super collaborative, but also like you have to always give your A game, right? Like you need to be in your A game always, because if there's a lunch and you're not paying attention, there's somebody's next to you, like you're missing a super opportunity. I'm sure you probably share the experience.
Yes, both on the deal side as well on the LP side, right? You have to uh, deliver the best value always, and you have to be on your A game.
Yeah.
Right, because you have to keep on constantly building your networks, not just with LPs, but to get access into the best founders, and for your founders to get them access to the best possible network out there.
Exactly. And also the feedback that we get in this industry, it's never instant, right? Like if we make, I don't know, like artwork, like we see right away what's the result. But in our work, like the feedback loop can be months or years.
Yeah.
So whether you did a good decision or you took the right, you picked the right company or founder, like you might know in next months or years. So I think it's so important that you're like really conscious of where you stand and what you want to do so that you can make sure that you're like learning constantly.
You're right. You're right. I think there is no other way.
Yeah.
You can't relax if you are in this industry.
Yeah, but I have to say now this summer, I was like scrolling through the LinkedIn and I feel like a lot of people are like talking about like, oh, like I had 2 weeks off now. I went to the mountains with my kids and my family. And like I think in leadership is so important to like take a lot of time off.
Yeah.
So, and I think this is also a thing that in Europe happens a lot, like people takes pretty long holidays. So, do you still see this? Because I know that the founders in India are like super hardworking.
Yeah, yeah.
So, what's your take there? Like, is it changing the way people are working in terms of founders? Is it going more to like lifestyle, or is it still like hardcore, maximizing the hours?
So founders in India are at least working like 7 days a week,
Yeah.
12 hours each day, not just founders, their teams
Yeah.
also. And deals are getting closed like, in a matter of days, the best companies. So we as a fund, our ICs happen on Saturdays and we invite our LPs to join because we know that, Monday to Friday, if founders are working with their teams,
Yeah.
we don't want to take 3 to 4 hours out of their time for an investment committee.
Yeah.
We schedule our investment committees on Saturdays. And in fact, like our CIO LPs, they cannot join from Monday to Friday, so they can join on Saturday. So
Yeah.
so we are working on Saturdays, right? And even to find the best companies, be on a WhatsApp message away to them. We like our entire team just replied within 10 minutes, even on weekends, to our founders, because like it's majorly a service-based relationship, right? You have to be available
Within
to them
10 minutes, you said.
within 10 minutes, yeah. And you can imagine if the world is changing so fast and the two powers that are happening globally right now, where there's such an intensity of work
Yeah.
and compounding is happening so fast, is US and India, right? And India is growing so fast. Then if European family offices are used to certain way of their life, right?
Yeah.
Where every Friday afternoon they'll go to the mountains and come back on Monday. A deal would be closed by then for us.
Exactly.
So
That's why the funds that they move fast, they pick the best, like they get the best deals.
yeah,
That's the reality.
yeah. So we asked them, you can outsource that kind of work to us and still relax in the mountains. Know that you are invested enough.
Exactly. If you do the fund, like you work the Saturdays and Sundays. I love that.
Yeah.
But I do think that it just creates such a like spirit of like let's be so competitive and we're together in this. We're gonna make it work. Like I come from sports background and for me like it was like gymnastics, for example. I was a coach. And I did it myself too. And for me it was like living and breathing the whole thing. Like it was not, I mean, the time when I relaxed, of course, like that's when the best ideas came from and you recover. But at the same time, like that spirit of like figuring things out with super high intensity, I think it's also more rewarding because you know what I mean? Like you're
Yeah.
just like pushing so hard.
And for us, our work is our play. So we
like
we
you're-
try to get the best. Like compete with ourselves. I'll not say compete with others, but compete with ourselves. Are we doing a better job today than we did yesterday?
Exactly. And I do think that, I mean, for us the same, like we're all about like how can we be better today, But also for investors the same. I feel like I really encourage and challenge like all the investors and families that like just don't settle on where you are. Like just like get exposure. Like the more exposure you can get, like you're just like learning so many things and you just like get stronger out of that.
Yeah, and let's say this specifically for European LPs and family offices, your downside might be like 1x, but upside can be like 5x to 10x.
Yeah.
So fund or directly or more, and plus the kind of learnings that you are setting up for yourself and your own kids, you can't put a money value to that.
Yeah. It's like you're creating your IP.
Yeah.
And like I do think that there is, I mean, what are you gonna lose if you call a founder?
Yeah.
You know, like what are you gonna lose? Like tell me exact amount of dollars you're gonna lose if you call a founder and he doesn't pick up. At least you tried.
Yeah.
You know? So it's like, and then you learn. And if he picks up, you're like, okay, let's have a meeting, let's have coffee tomorrow. So in the end, I feel like, and especially for being a fund manager, like you need to be like super for leaning. Of course, you're with your network,
Yeah.
it's amazing, but like otherwise, you're not gonna get the best founders.
Yeah, I'll say one more reason, why we are sitting in Europe today in Switzerland and why we are liked by European LPs is like we are super humble, right?
Yeah.
And I think that is one trait that is liked specifically by family offices here. What might have also happened in the past is they might have a brush with some American managers who might have been not so humble and
Yeah.
might have been like little proud or arrogant, and they don't like that. So that's why I'm saying more and more of money would I would say flow to India
Yeah.
from this part of the world.
Because it's more down to earth.
More down to earth, more grounded, and more hungry, right?
Yeah. Yeah, that yeah. How do you how you're hungry and humble at the same time?
So it comes from our roots because India like 50 years ago or 40 years ago when my parents were growing up was not a rich country. It was just uh, getting out of independence, still building the systems, right? So my parents, they advised to, or they were also advised by, let's say, my grandparents to go to find a government job.
Yeah.
And we were also advised to find not to take risks, do government jobs. So we come from that background which has not seen opulence.
So, but how?
And that's why the hunger and the humbleness is because we realize that anything that we accomplish, it's also like part cultural, part spiritual, like everything is temporary.
Yeah.
That's what we are taught.
The change is constant.
Yeah, change is constant. So,
Yeah.
so you can't sit on your all like what you have accomplished. It will change, and we are seeing the world changing around us so fast with AI.
It's insane. And what is like the last, I would say, like what's the latest learning that you've had in the space? You also spend now
Yeah.
time in the US.
So I'll say what like Jeff Bezos say. If people ask question, what is in the next, what is the thing that's going to remain constant in the next 10 years?
Yeah.
Be it AI, be it robotics or anything. Invest in the greatest of people. If you find people, no matter what they are doing, just go behind them, even if you're not able to understand what they are doing.
Yeah.
Just build your framework to evaluate people and find and back the best of them. And when you back them 100%,
Yeah.
because that's going to be constant
Yeah.
throughout.
Like they'll figure it out.
They'll figure it out. They'll
Yeah.
figure it out. Right.
They have the hunger to just
They have
like
the hunger.
there's no other options.
Yeah. But if you are investing in trends, today it might be AI, tomorrow it might be robotics,
Yeah.
the day after tomorrow might be quantum.
Yeah.
So trends might change, but the best of people, they'll figure it out. So rely on them.
Yeah. So invest in talents.
Yeah.
I think that's a great way to wrap this up, right?
Yeah. Yes. Thank you so much. It's been a pleasure.
Thank you. My pleasure.